Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so on this video we're going to go through a whole bunch of housing data, historical and now, to forecast what's going to happen, we think, in the spring.
Okay, but if you're new to the channel, please subscribe, hit the notification bell, like the video, share the video, leave us a little comment, tell us where you're from, and let's go.
Okay, and the reason you want to do that is because you want to come back and watch our videos in 4 or 5 months so you can see how right we were. Because we've pretty much nailed this the whole way along. And what we're going to do is we're going to show this data.
And we don't suffer from modesty at all.
Absolutely not. There's no modesty here because we're going to start with what we're going to do is we're going to go through these charts. We're going to talk about what people are thinking and saying and what's actually happening. Okay. So this is data. This is data from the Federal Reserve. We're going to put the first chart up here. Oh, before we put the first chart up, okay. The conventional wisdom is the housing market is going to crash because interest rates are too high. People are going to panic sell and inventory is going to rise. That's what happened in 2005 and 6 that caused the housing crash. Okay.
That was part of it. Yes.
That was part of it. So we have to have a high inventory. That's one thing we have to have because if you have low inventory, home prices don't drop because there's not enough panic selling, right?
Right. There's also not panic selling when people can easily afford their payments or they don't have payments.
Okay, we're going to talk about that because the other conventional wisdom is that interest rates are so high nobody can afford. We're going to show you data that you're going to when you see the data, it's going to completely change your whole belief system around this. And we're really excited about this because we've spent a lot of time talking about this. The Federal Reserve releases data every month, basically. So we're when we look at the data, we're like a month behind, but we actually know what's happened in the last 6 weeks. Mm-hmm. And the changes are substantial. We're gonna talk about that. Okay, so the first thing we're gonna talk about is active listings.
Okay.
This is the canary in the coal mine. When this number goes up, this is the scary thing that's going to crash the housing market. Mm-hmm. So here's the first chart. This is the active listing count in the U.S. historically. It goes all the way back to 2017, so we have 5 years of data here. Mm-hmm. All the way to the right of the chart is where we are now. This is the total number of active listings in the U.S. And as you can see, it's peaked. The 6-week data it's dropped substantially. Matter of fact, in Las Vegas, it's dropped 20% from October 21st to today, this is actually Christmas Day. We're doing this on Christmas Day, so you'll see this on the 26th. Okay, the listing inventory is substantially down. This data only goes up to November. Okay, Juana, when you look at this chart, there are two things that I want to point out. Every year, the number of listings declines, and it goes up, and it declines, it goes up, it declines, it goes up. It does that every year. The listings increasing in the fall is an annual phenomenon. It happens every year. Mm-hmm. But what's amazing is we've already passed the peak of the total max listings. We're already declining, and we are way below, like almost half mm-hmm. of historical. Look at the numbers, 17, 18, 19. We're half of the historical number of listings, and it's declining. So just that data point, forgetting everything else happening, because there's other things happening. What does that tell you about what's potentially going to happen in the spring?
Yes, we're going to have more listings in the spring, but the thing that we all have to keep in mind is who's actually going to be selling in the spring. I think that some of the people that would have normally sold in the spring are going to really rethink the whole thing because do they really want to give up that 2-3% interest rate and trade it in for a 6% interest rate? Maybe, maybe not.
And we have a graph we're going to show you that's going to really put this in perspective because we've talked about this quite a bit mm-hmm. about the number of people that own homes cash and the number of people that already have these mm-hmm. existing low interest rates that have decided to not sell and convert over to rentals. Okay, housing inventory. We know it's low. It's going lower. And in the spring, there will be more people to put their homes on the market, but they don't stay in active inventory because buyers come out in full mm-hmm. force. So when you see these ups and downs, it's already going down. Remember, these numbers look back 55 days, mm-hmm. and we have the data for the last 6 weeks, and it's already started declining. I don't know if we're going to get down to that when you look at January, which was the spring of 2022. but we're definitely going to be below 2017, 18, and 19. And the housing market didn't crash in those years, despite much higher inventory.
Right. And we really don't see anything that would substantially harm the current housing market as it stands. Remember, the housing market as it stands now is in a very unique place because we have almost 40% of the market that's owned free and clear. We have a substantial balance of the market that has a lot of equity and has these super low interest rates. So we're in this really bizarre place where we haven't been before, and people simply don't want to sell their homes because of all of these reasons.
Okay. So the next thing is, but home prices. Home prices have tanked, and you've heard some ridiculous numbers that are mostly not true. Okay. So we're going to actually look at the actual median list price changes of the housing inventory. This chart also goes back 5 years. Now, as you notice, every year what happens? The list prices go up in the fall or in the spring, and they drop in the fall. You can see 2017, and they declined going into 2018. Then they went up, and they declined into 2019. Then they went up, then they declined into 2020. Then they go up, and they declined into 2021. Even in 2021, home prices increased and dropped again in the fall because of median list price. And guess what this number is every year? This number is 3 to 5%. Now, remember, the bottom baseline you're seeing is 240,000. That's not zero. So when you look all the way to the right and go, but look at 2022, it's really in a free fall. That is 7%. It's only 2% more than these other years. And this is off the highest ever. So you can't just say, even list prices are still higher than they were in 2021. Like, it would have to tank substantially. And we've already seen what happened with the housing inventory starting to decline. So what is likely to happen in this scenario is, guess what's going to happen in the fall? List prices will at some point bottom out, and or in the spring, they'll start to increase again. But it's like, this is just showing what happens every year. And every year we get these morons who make these ridiculous statements about how housing is crashing this year because, look at the number of sales are down. Well, numbers of sales are down every single year. We actually you read a statistic that what was the number of sales difference between now and historical? Do you remember the number?
I don't remember.
Is a percentage?
I don't remember.
It was sales are 4% less.
Okay. Yeah, we were looking at so many charts, I don't remember.
The total number of sales in a given year is 4.7 million.
Right.
And they're 4.5 million.
Yeah, it was...
That's the crash, 4%.
It was negligible.
It's absolutely negligible. So let's talk about this because the chart's still up and they're looking at it.
Well, what I like, look, so first of all, I don't have my glasses on, so I can't see the chart. But what I do know about the chart is just look at the overall trend. You don't have to look at the numbers. You don't have to look at the micro as far as how much up and how much down, but just look at the overall trend of this chart. And that tells you that the whole picture. It tells you that real estate does this, but over time, it's still at this angle. So
it's backwards for them. It's at this angle.
Oh, sorry.
That's okay. Don't look at her hands. Look at the chart.
The point is that it goes up, okay?
So we have long-term trend, and then we have annual cycles. So we have all these people wrapped up in the short-term annual cycle because for two reasons. One is because they're trying to get attention, and the other reason is because they get YouTube video views, right? Or people click on their article in their blog, and they read the article.
Right, and that's all fine and good. And I don't really care about that. What I care about is numbers. And I like looking at data, particularly data that's put out by the Fed like this, that gives us hopefully an impartial historical view at the numbers, and we can draw conclusions. You don't have to be an economist, you don't have to be an MBA to draw a reasonable conclusion by looking at this graph.
The other interesting thing is that this all happened with interest rates going from 3% in January to 7% in October. Mm-hmm. They've already declined. and they're not projected to go back up to above 7%. Like there's zero people estimating, and we're talking Fannie, Freddie, all the data analytics companies, all the senior economists, nobody's predicting it.
Right, and whether they're predicting it or not really isn't that as relevant as just all of us just looking at the trend lines, right? Just looking at historically what these numbers are doing. We can all surmise what's likely to happen.
Yeah. Okay. We're going to go to the next one. Now, this is going to blow your mind. This is the next chart is mortgage debt service payments as a percent of disposable income. Now, the conventional wisdom is people can't afford to buy houses because they're so expensive. 7%. Oh my gosh, the mortgage payment went up 50%. So they were going to pay $1,800. Now they're going to pay $2,600 or $2,700 or whatever the numbers are, right? And nobody can afford that. Okay, now this is what this chart shows. This chart goes all the way back to the 70s, okay? This is the total disposable income in the US. And then this is all the people with mortgage debt. This is the total amount of mortgage debt as compared to all disposable personal income. You can see the peak was the previous housing crash. That is one of the factors for the housing crash. Mm-hmm. So there was just a ton of people over leveraged, right?
Right.
We have the opposite thing now. The mortgage debt is a percentage of personal income is literally today's thing all the way to the right. It's never been this low since it's been measured.
Right. And when you're sitting there thinking, well, this doesn't make any sense. Because when I first looked at this, I went, wait a minute, I don't get it. So I had to think about it for a little bit. So keep in mind, at the beginning, I reminded you that about 40% of the housing out there is owned free and clear. And then you've got the other 60%, majority of those people have very little debt, relatively speaking, against the equity of their home. So now when you're combining that, that's how we get to this number.
Yeah.
Because there is so much free and clear real estate, partly because individuals own their homes free and clear, partly because, remember, about 18% of the market out there is owned by the institutional investors who own these homes also free and clear. So all of this plays into all of these numbers.
Yeah, so I'm going to put this in perspective. The number is $3 and 3.98. What that means is for every $100 of disposable income, only $3.98 of that is being used to make a mortgage payment by somebody. Now, this is counterintuitive. You're like, oh, that can't be right. And you may say, wait, I pay 28% of my disposable income toward my mortgage. How's that possible? And that's okay, you might do that. But what about your next door neighbor who has your same income, who owns his house free and clear? He pays zero of his disposable income. So now he's paying zero, you're paying 28. So between you, we're down to 14%. Mm-hmm. And then what about your other neighbor? Well, he put 20% down and he also bought his house a long time ago. So he's maybe paid a lot of it down. And so his mortgage debt is maybe he only owes $30,000. And we meet a lot of these people. Mm-hmm. They only owe, when I ask them how much you owe, oh, we only owe 30 grand on the thing. So, and here are the real numbers. Juana was going over them. 40% of all homes are owned free and clear, either by people like all of us, right? We just own a rental house, or you own your personal residence. And then the others, or investor owns them. And then the other 60%, 90% of the 60% have, when they bought it, put more than 20% down. Mm-hmm. So they're anywhere from they owe $1 to they owe 80%. Mm-hmm. So when you take 90% of 60% and then add that to the 40%, you only really have about 5% of all homeowners who don't have 20% down. Mm-hmm. That's what this reflects. What this reflects is, from a macro sense, we don't have anything that would, from a mortgage standpoint, yes, it has created an affordability short-term problem, mm-hmm. but that's in the past because we already reached the peak of interest rates. Meaning the numbers don't even reflect that because, remember, that hasn't been measured yet because we're already past the peak.
Right. So I know this kind of turns your brain inside out, but let it percolate and you'll get it. What troubles me about this is that once the federal government figures it out, as far as the lawmakers are concerned, they're going to have to find a way to reach into our pockets, and that concerns me because
it's possible.
Because there is so much equity, there is so much money tied up in people's homes, and I mean, there's been talk off and on of a wealth tax, and I think with these numbers, they're thinking about it again. I think that the wealth tax talk is going to be coming back, and I hope not, but I think it will come back.
And just so you guys understand how this works, they will get this passed by saying they're going to tax the billionaires, but then they'll find a way to tax. This is how they'll start it. If you own a house and it's worth over $5 billion or $5 million, we're going to charge you a luxury tax. X% of the purchase price is when you sell it, maybe, is an off the extra tax.
Well,
so it'll be an additional tax.
Okay, so to that point, LA has already done that.
Okay, we're going to do a whole video on that.
Yeah.
Okay, because there are going to be other things. But what happens with all these is they just, to raise more money every year, they just keep lowering the threshold. Eventually, they'll just get to the point where, look, if you have a house, we want 2 or 3% off the top. So it'll just be an additional cost when you sell your house.
Well, I think that what they're going to do is they're going to actually do it as part of your income tax, the way your property tax is calculated, because they want the money now. They don't want to wait until you sell the house.
Right.
Because I think that's the way it's going to be. And if you think that that's not the case, think about the way originally the U.S. income tax code was written, that it was supposed to be the millionaire tax. And I don't know about you guys, but even when I was a poor college student, I still paid income tax.
Right.
So it's not a millionaire tax, nor will tax on real estate equity be a millionaire tax.
Okay. The next thing we're going to talk about is, okay, you have the people. Remember, nobody's forced to sell. This is different than the housing crash because people have very low mortgage payments. Remember, we're talking 95% of the people can totally afford their house. And if they need to move or whatever, they can always rent it. Now, you're probably like, yeah, but that's going to run out of steam. So what we did is we went and found the rental vacancy rate in the U.S. So I'll put that chart up right now. Mm-hmm. Now, as you can see, the rental vacancy rate in the U.S. is the lowest. It's pretty low. It's 6%. Now, you say that's super low. That's at 5% is considered the normal number for when a person moves out and then you have to put a new tenant in. Mm-hmm. It's 6. This means 6% of rentals are vacant, but that's the normal. That's like unemployment being 3.5%. Those are just people going from one job to another. So this is actually the lowest it's ever been. And if you go and look back at the previous housing crash, you saw that there were, for the last whatever, this chart goes back to 40 years almost. The rental vacancy rate's the lowest it's ever been. Mm-hmm. It's the lowest. So what that means is the people who say, well, I'll just rent it out, they're going to get a tenant and they're going to be able to rent it out. It's not like they're not going to be able to get a tenant.
Right.
Now, this shows us two things, Juana. What does this say about future rent prices, a possible what's going to happen to them? And then what does this say about homeowners having more options than just having to sell the house if they have?
So a couple different things. If housing inventory is tight, then that impacts the rental market as well. So that makes the rental market tight, which means that rental prices will at the very least remain stable, if not increase. As far as the higher the interest rates are and the more it costs an investor to purchase a house, the more that investor has to recuperate that cost or cover that cost. And again, that brings forward a higher rent payment. As far as having a low vacancy rate, 6% is a pretty low vacancy rate. Again, that brings us to the same point, supply and demand. Generally, people need to live somewhere, and if you can't buy, you're going to have to rent. And if you have to rent and 94% of the homes out there are rented, that leaves you with 6%, and it leaves you in competition with everybody else who needs to rent, and therefore that supports rental values as well, at least keeps them constant, if not increasing.
Okay. Now, The next one we're going to look at is the homeowner vacancy rate. The homeowner vacancy rate is highly indicative of people who have basically moved out of the house because they just can't afford it anymore, and it's completely vacant. It's not utilized as either as a rental, or it's just basically empty.
Well, it is, and those people are more likely to be more willing to be more flexible on their price because they need to move that house because it's vacant. They're not using it as to produce income by having a rental, and they're not using it for their own personal residence. So that is just money that's being sucked out of their pocket. So it makes it more likely that they'll be more flexible on price.
Okay, so we're going to put up the chart. This is the homeowner vacancy rate in the U.S. All the way to the right, this is the most recent data. It's 0.9%.
And what's interesting is if you look at this chart, because I actually had to go back and kind of move my mouse over to find the last time it was 0.9, and I think it was 1978, and the time before that, it was 1957. So, okay.
So that's over 50 years.
So what does that tell you guys? I mean, if more than my lifespan and more than Todd's lifespan, not together, not combined, but more than each of our lifespans.
We're Gen Xers. We're not,
if this is going back that far, and there's only been twice, 78 and 57, that the vacancy rate has been this low, that tells us that homes are being utilized, which means that people are living in them, so they are not a negative cash flow situation for them, or they are being rented, which means that they're producing income. So that's not an opportunity for somebody to say, hey, this homeowner has a property that's actually a drag on their finances.
The forward-looking, what this means to me personally is that the housing market is very efficient, that we don't have a lot of, it's efficient and highly utilized. That a house is an asset that is immediately used upon purchase to either be that's occupied or that is rented out. That we have less than 1% of homes that are just sitting there empty. And if you look back at the previous housing crash, you can see that number was huge because of the overbuilding. It's literally the opposite. So when you see the videos where they go, this is going to be worse than 2006 was and 8 or whatever, it's like the numbers don't support any of this. It's all made. It's all made up. It's complete fantasy land. Like nothing that we've shown points to anything bad. And if you didn't know two things, if you didn't know what interest rates were doing that are already going down, and if you didn't read the bad news that are just attention-grabbing headlines, right? Because you read the headline, it says it's going to be worse than 2008 was, and then you read the article that the economists is quoted, and they said home prices would likely go up, over the course of 2023, and then you're like, wait a minute, how's that worse, right? Like it's almost ridiculous. As we look at this data, none of the data points to anything. And we use this data to make decisions for ourselves. We use this data to advise clients what to do. And people like to take little small pieces and just look at the little. We've shown you literally 50 here. This is like almost 70 years of data.
Right. To me, this is the most telling out of all the charts that we've put up. Because with the low vacancy rate, that means properties are being utilized. That means that they're either, like I said, generating income because they're a rental, or people are living in them, and that's a good thing. So when properties are being utilized for whichever purpose, that means that those properties are less likely to fall into disrepair. The owners of those properties are less likely to be in financial difficulty, and all of that supports a good, healthy real estate market.
Okay. We're going to now talk about a couple things. We're going to talk about the people who panic sold in the last 2 years because they got told, let's sell the houses now and buy them next year when they're 50% less. Okay?
So anybody who said that, did they do it? Because I'm willing to say that they didn't do it.
Okay, so here's the problem. if you sold a house and didn't immediately buy another house, which you wouldn't have done if you thought prices were going to tank, you wouldn't have 1030, you would have just sold and taken the gas. You paid at least 15%, if not more, depending on how long you had the house. You paid probably close to 8% in total selling fees. And you've had 2 years of not getting, let's say, a 7 or 8% cap rate on your investment. Mm-hmm. So you're basically, home prices would have had to fall 36% for you to break even. And we've already shown that list prices have dropped 7% from the peak to now, but this is seasonal. And they're like it's likely that home prices will moderate. That's sort of been our prediction for 2023, right? Home prices would moderate. They would find some point and they would sit there. Now, when we showed you the graph that showed how much mortgage service debt is a percentage, it's only 4% of all disposable income. That's really telling for me, and this is why. I grew up in a family that we never owned a house. We always had mortgage payments mm-hmm. because my parents lived paycheck to paycheck. Mm-hmm. And so for us, the only path to home ownership were loans. Mm-hmm. So we had to borrow money to buy a home. Right. And then they didn't make enough money to ever pay off the house. They were always sort of just servicing debt their whole life, and they never. So average people, people that want to buy houses, workers, we'll call them entry-level people, they're at a huge disadvantage. You have two classes of people, right? You have those people, and then you have all the people who bought, because we know half of all homes are being bought with cash. Mm-hmm. And we know that anywhere from 18 to 27% are investors, either hedge funds, New York City, Wall Street firms, Blackstone, or investors who have cash still mm-hmm. buying up houses.
Yeah, so that's a lot of cash out there supporting property values.
And the conventional wisdom is that 100% of people, if mortgage rates go up 4%, then home prices have to go in half because payments go up, and it's like a string. You pull this one and this one goes up. But people that pay cash, how much do they care about mortgage rates?
Not at all. If anything, they're looking, particularly in this environment, we've talked about this before, people are paying cash for homes because they're using that as a way to hedge against inflation and park their money in an asset that is likely to devalue less, if at all, compared to cash.
Right. The reason we share this data with you is, like I said, it'll probably be a few more weeks. We'll be able to get the next month of data. We already know that inventory is declining, and we already are going to see, it probably will take until April for us to see the February data, which is right around the time when median list prices level off before they go up. That's the problem with this specific data. We can see it through Altos Research a little quicker because mm-hmm. they pull the data a little faster. This data is sort of, it's grabbed in blocks and imported, and then it takes a while for us to actually be able to see it. But we do have leading indication that we've done on other videos that show this is a normal housing market. This is not, it's not hot like it was in 2021 and 2022, but it's a pretty normal housing market. So this idea that it's going to get terrible, it's going to get worse, and blah, 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 none of it's happened. And all we've heard is anecdotal information of some builder who was selling homes for $1.2 million is now selling them for $900,000. But that doesn't mean home prices are down 30%. It just means a specific builder overpriced their product and they demand got wiped out. Now they need to move the product. Mm-hmm. But we're talking about macro factors, right?
Right. So builders are definitely adjusting to the current environment because they do want to move product. But we've talked about this before. One of the issues with the builders is that they actually have relatively small margins, so they're very sensitive to what's happening in the market, and that's part of the reason why there are less building permits pulled, why we're going to see a lot less building in 2023. And that's just going to put more pressure on the existing housing stock because there will be fewer homes, more people, and we're looking at the very least at a stable housing market, if not one that increases in value. Not everywhere. It's going to be in pockets. because real estate is hyper-local, but it'll be interesting to see what happens in everybody's market. Tell us what's happening in your market, and tell us what you think of these graphs. Do you like the Fed graphs? We personally like them.
Yeah, this is Federal Reserve.
Yeah, so if you like these graphs, let us know, because we like them. If you have a different source of graphs that you think are very helpful, please let us know. We'll be more than happy to check them out. We appreciate all the comments. We hope everybody had a good Christmas. Please be kind to each other in the comments. Please subscribe, like the video, share the video, hit the notification bell, and we'll see you on the next video. Bye.
Bye.